Hello student, welcome back to the part 2 of the sources of business finance. Here we are going to discuss some of the points about the equity shares, preference shares, retained earning, global depository receipt, American depository receipt, IDR, which is international depository receipt. Okay, so let's move ahead with the equity shares. Equity shares represent the ownership of a company. They have right to vote, right to participate in the management. Okay, means glimpses a brief, in a brief it means a owner of the particular company, the owner of the company, which clarifies the decision making like voting right and all, and participates in the management, that are only called equity share. Okay, so moving ahead in the chapter, advantage and or the merits of the particular equity share. First one is a permanent capital. Equity share capital is an important source of finance for a long term. Okay, they are the permanent capital, which are the investment for the long term, which already I have mentioned in the previous video. Okay, next one is the no charges on asset. On raising fund by issue of the equity shares, a company does not need a to mortgage its assets. Okay, since the equity shareholders become the real owner of the company, so they don't need to particular activities like any kind of activities. Okay, so they have to not charge any kind of assets. Okay, whereas in the debenture holders we will be reading about it. Okay, higher return, equity shareholder get higher return in the year of the high profit. Means if the company is having a high profit, they get a higher return. Next one, control. They have right to vote and right to participate in the management. Means the control is in their hand. Okay, they can control their activities. Next one is no burden on company. Payment of equity dividend is not compulsory. It is not compulsory. It may be the time when uh, amount is less, you have to distribute among the creditors. So in that case you don't have a burden to particularly verify the dividend and payment has to be made. That is not necessary. Next one is the limitations and the demerits of the equity share. First one, risk. Equity shareholders bear risk, higher risk, because payment of equity dividend is not compulsory. Means there can be a situation where they are not required. Higher cost of the equity share is greater than the cost of the preference share. Means the cost of equity share is greater than the preference share. Means if the preference shares value is rupees 10, then the cost of equity share would be 20 rupees. Next one is the delay. Issue of equity share is time consuming. Means a time is taken for the issue of the equity shares. Issue depend on the share market condition. Equity shareholders are the primary risk bearer. Therefore, they demand the equity share is more boom time. Okay, the more the boom period, the more equity share will be demanded in the market. Okay, so the next topic is the preference shares. Okay, preference shares are considered safer investment as compared to the equity share. They receive dividend as a fixed rate, and preference shareholders are like a creditor. They have no voting right. Okay, means they are having a fixed amount of dividend which has to be paid to them. Okay, and they are kind of like a debenture holders, you generally can be verified. Okay, next one is about the merits of the preference share. Investment is safe. Preference shareholder investment is safe. They have a preferential right to claim the dividend and capital. No charges on asset. The company does not need to mortgage its asset to of issue of preference share. Means no company has to be give the mortgage to a particular preference shareholders. Control. It does not affect the control of the equity shareholders because they have no voting right. Means preference shareholders are not having any kind of voting right as compared to the equity shareholders. Next and the last one is the fixed dividend. They get fixed dividend, so they are useful for those investors who want fixed rate of return. Means a kind of flexibility is there. Means a fixed rate will be given to a particular unit. Okay, next and the last point is about the limitation and demerits of the preference share. Means costly source of fund. Rate of preference share dividend is greater than the rate of the debentures. For a company it is costly source of fund than debenture. Means for the company, preference shareholders are always costly. No tax saving. Preference dividend is not deducted from the profit for the income tax. Therefore, there is no tax saving. Save, particularly tax cannot be saved from this. Okay, not suitable for risk takers. Preference share are not suitable for the those who are willing to take the risk for the higher returns. Okay, they cannot take it. Okay, who are not suitable to take the higher risk. As a dividend, only this shares is to be paid only when the company earns profit, so investor may not be very attractive to this. Okay, investors are not attractive to this, generally they are not attractive. Okay, next point is about the retained earning. Okay, so let's go ahead. A portion of company's net profit of after profit and dividend which is not distributed but are retained for the reinvestment purpose is called retained earning. This is called source of self financing. Means generally this happens with the case of the companies which are looking for a further expansion. Okay, so let's have a glimpses of the merits. No cost is in the form of interest, dividend, advertisement and prospectus to the incurred by the company to get it. Okay, no cost is in the form of income, they don't require any kind of interest. Okay, no charge on assets. The company does not have to mortgage its asset, means they have to not keep the assets in the form of mortgage. Next one is growth and expansion. Growth and expansion of the business is possible by reinvesting the retained profit. Okay, means it is possible to get it, but the growth and expansion has to be done by the institution, so that may affect it. Okay, now moving ahead in the chapter, we will discuss about the demerits. Next one is uncertain source. Means what does uncertain source means? It is the uncertain source of fund because it is unable only when the profit are high. Okay, when the profits are high, they will get a good way. Okay, so the next one point is about the dissatisfaction among the shareholders. Retained earning causes dissatisfaction among the shareholders because they get low dividend. Okay, they get low, uh, particularly get low dividend, so they are dissatisfied with the activities. Okay, so moving ahead about the GDR, Global Depository Receipt, is an instrument in which a company locates its domestic country, issues one or more of its share for convertibility bonds outside the domestic country. Means whichever the country it is issuing will issue this outside its country. Okay, our domestic country. Next is one is about the American Depository Receipt. An American Depository Receipt (ADR) is negotiable certificate issued by the U.S. Depository Bank representing a specified number of shares, often one share of a foreign company stocks. The ADR trade on US stock market as any domestic share would. Okay, means it is issued in the US stock market. ADR offers US investors way to purchase stock in the overseas company that would be able or otherwise the foreign particular investment. Okay, uh, the foreign firm also benefit ADR. Uh, foreign bank generally uses this kind of activities. Okay. Next and the last one is the international depository receipt. An international depository receipt is a negotiable certificate issued by the bank. It represents the ownership of a number of shares of the stock of the foreign company that the bank holds its trust. Okay, means it is an international unit which has issue a negotiable instrument. So this was regarding the chapters which we will have concluded for this video, this much, and in this video we have learned about different kind of receipts and about the many sort of things. Okay, so this will help you to gain a good marks in the exam. Thank you.